Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, investment markets continue to be incredibly exciting at the current moment in time. So just to give a recap of where we are, the S&P 500 over in the US rallied, and when last week it was around 3,100. If you remember, we spent a lot of time around the 3,000 level. We eventually broke to 3,100, but we very quickly rallied to 3,200 and eventually broke through that. And we hit a high of 3,232. So that almost cleared the year-to-date losses on that particular index. And we are now only 5% from the all-time highs. Now, if you go over to the NASDAQ composite, so this is much more tech-heavy, we actually hit an all-time high this week, and we finished over 10,000 for the first time. So that is obviously very bullish, and it feels like it's only a matter of time until the S&P 500 and perhaps the Dow Jones also push up towards those all-time highs. And the FANG stocks, so the Facebook, Amazon, Netflix stocks, are all also trying to push up towards their all-time highs. Now, the US tech stock is very much back in favour. There was a period where we started to see a rotation into financials, which and other cyclical sectors, which has continued, but we started in the last couple of days to see maybe a reversal of that rotation, almost a rotation of the rotation, which has been quite interesting to watch. Now, why has the market rallied so strongly in the last week? Well, it was a jobs number in the US that triggered the upward rally. Now, the US economy surprised everybody by adding 2.5 million jobs during the month of May. Now, economists were expecting another massive decline in job numbers, but the addition of 2.5 million jobs caught everybody by surprise, and it meant that the market started to price in the fact that the US economy was proving much more resilient and already on a V-shaped rebound. So the market bounced to the upside, and we saw that reflected in the UK and in European stocks. In fact, we saw it reflected globally. The FTSE 100 rallied up above 6,500. And since then, we've had a little bit of a pullback, which I'll come on to in a moment. But the fear index in the US, so the VIX, which is called the fear index, the VIX, actually fell and dipped below its 200-day moving average, which is around 24.69. So going below that level is actually very positive. So again, it was another one of those indicators that were ticked in favour of the bulls out there. And those bearish investors seem to be capitulating even more. But of course, this market has risen very quickly. And of course, if you look at valuations, they do appear quite stretched. So this FOMO, fear of missing out, was seemingly accelerating, particularly in the US. Now, to give you an example, a perfect illustration of this, now Hertz, which obviously most of you will know is the car hire company, filed for bankruptcy protection in the US, and its share price obviously plummeted. And we went from a point of 80 cents for each share. That rallied 40% in a matter of days at the start of this week. So we started to see an almost worthless, supposedly bankrupt company that's got huge amounts of debt, seeing their share price rally by 40%. And what was happening is we're seeing lots of people speculate on shares. We're seeing a lot of people rushing to get invested in almost anything, no matter how seemingly worthless the share price is, almost betting on penny stocks. So that is a bit worrying. That's got to the sort of euphoric stage almost of feels like a bubble. So we would be looking to see if markets would pull back from here. Now, what we've seen in the last 24 hours is the market looking very stretched, but the Federal Reserve, so the US Federal Reserve, that's the American equivalent of our central bank over here, the Bank of England. The US Federal Reserve gave a statement on their monetary policy, and they didn't change anything. And in fact, they emphasized that interest rates won't be rising, obviously this year, probably not next year, and their accommodative stance would continue. But they also gave a very gloomy view of the US economy. They re-emphasized that we're far from out of the woods, and whether a V-shaped rebound would even happen was called into question. That gave a dose of reality to a market that was pricing in that everything was over and we're all back to normality, despite the fact that coronavirus doesn't have a cure. So that dose of reality was also compounded by news that certain parts of America were seeing an increase in coronavirus cases. So people started to get worried. So it was the first time, seemingly almost in weeks, that we've had people start to think about the reality, the fundamentals out there. So we saw stock markets pull back slightly yesterday. That was Wednesday. And today, as I look at it now, the stock markets are down 2 to 3% almost across the board. Even the S&P 500 now has pulled right back, broken down through the 3,200 level, is now testing the 3,100 level. If you go back to last week's show, I talked about that level, and also then the next one down, which is the 3,000 level, which is around the 200-day moving average for the S&P 500. So we're seeing a slightly negative tilt to markets. It'll be interesting to see if the bears jump on that and if the bulls capitulate. But the odds at the moment are still in favour of this uptrend. So we have to wait and see what happens. Interestingly, if you look at the bond market had sold off in the last week quite aggressively. And we saw the 10-year US Treasury yield rise to about 0.9%. That has now started to fall as people are rushing for havens, and that's down to about 0.67 as I look at it. Gold has held up throughout this period of euphoria in stocks, and even now is starting to continue to push higher, which was one of the outliers, because despite all the euphoria on stocks and bond markets also selling off, gold was seemingly managing to hold its price. So that was showing there was still some uncertainty in the market. Of course, if you looked into Europe this week, we already were seeing signs of exhaustion in the German market, the DAX. We were seeing it in the UK. And so we were already down about 5% from the high that we saw this week. Of course, European markets are still somewhat adrift from their all-time highs that we saw in the past. I mean, particularly the FTSE 100. But we've already seen the European market start to pull back before the US markets have started to do the same. And in fact, the German DAX, is down around 5% as I make this show. And it's the correlation between the German DAX and the S&P 500 is always interesting. There's often been a correlation that when the DAX has started to sell off, it's been a bit of a drag on the S&P 500. We shouldn't be surprised if two of the most important stock markets in the world had this correlation. So it was almost like the German DAX was flagging that we might perhaps have some kind of pullback on equity markets in the US. But as I say, this isn't surprising given how quickly and how far equity markets have rallied. So in the coming days, keep an eye on those support levels. So on the FTSE 100, sort of 6,100 going down to the 6,000 level. On the S&P 500, look at 3,100 and 3,000 to see if they hold. If we start to break below those levels, then this sell-off could be more than just a minor blip. And the pound has risen quite aggressively against the dollar. We hit the $1.27 level quite unexpectedly, actually. And it was looking like it was going to push towards $1.30. Now, the reason the dollar's been falling because the fear had started to evaporate from market and interest rates in America look like they're going to be staying lower for longer. So we saw the dollar fall against nearly every other currency out there. So that meant that the pound rallied against the dollar and pushed much higher, even though the UK economy still looks to be struggling. We're still not out of this coronavirus uncertainty. And obviously, Brexit is still in the background. But we've started to see that trend slightly reverse in the last day or so. We'll have to see if that continues, if the pound does start to weaken against the dollar and the dollar strengthens. So the message is, the last couple of weeks, we've seen the bulls take charge in equity markets. Risk on has been the message. And we've been seeing cyclical sectors do very well. Everything that was unloved during the worst part of the coronavirus downturn has rallied. But then in the last few days, we're starting to see whether that rotation and all of that is being undone again as people start to worry, are we going to see a pullback like we did during February and March? So there's a lot to watch out for. Of course, I've not even mentioned Donald Trump and the US-China trade war. That seems to have taken a little bit of a back seat this week. But there's a lot to keep an eye on in the next couple of days and weeks. And of course, we're going to soon start to head into the next earnings season once we get into July. So that will be something else to start to worry about. But there's a lot going on in investment markets, so do keep an eye on them. That is it for this week on Damien's Midweek Markets. As ever, you can follow me on Twitter. Money to the Masses is the Twitter handle with the number 2, Money to the Masses. Email address, damien@moneytothemasses.com. Of course, you can find me on Instagram, Facebook. Don't forget to join our Facebook community, facebook.com/groups/money to the masses. And do subscribe to our YouTube channel. We've just hit 1,500 subscribers, so thank you to you all. And if you've not already joined them, then please make sure you do.